Hi, welcome to Chapter 4 of the Introduction to Finance text. This chapter addresses ratio analysis, specifically ratios derived from financial statements. So let's get started. In general, we want to use the financial statements we've worked so hard to understand how to create to help folks answer questions like, should I make an investment in this company? Should we make a loan to this company? How does this company look compared to its competitors? And that sort of thing. And individual financial statements, as we've seen before, don't help us very well to answer a lot of these questions. For example, if we're looking at a company with a loss on their income statement, we don't know, looking at just one statement and not looking at competitor statements, whether that was anomalous, did competitors do better, etc., etc. So what we want to do is try to improve on this, and in general, we're going to be looking at a company's performance in two dimensions as we move through this improvement. First, we'll be looking at a company compared to its history, and second, we'll be looking at a company versus what we call its comparables or comps. Comparables or comps are a subset of a company's competitors. Specifically, comps are competitors that operate only in the same industries as our primary company under consideration. I'll talk more about that later. So if we look in the dimension or along the axis of a company's history, one way to look at this is to use what's called common size financial statements. And how these work is that on income statements, everything is set as a percent of sales. This is kind of a good thing because sales is really the cardinal measure of the size or scale of a firm. Notwithstanding what the folks, morons and otherwise, on CNBC will tell you about equity market cap measuring the size of a firm. As we'll see when we go forward, that's not an appropriate measure of the size of the firm. And again, I'll talk about that a little bit more later. Another way to look at common size financial statements is to look at balance sheets. And the idea there is to set everything as a percent of total assets on the balance sheet. Okay, we're going to use through this whole chapter a very interesting example that takes place at the time of the Great Recession. Specifically, we're going to look at most recent financial statements filed as of Q4 2008. And we're going to start by looking at Continental Airlines. Continental has since merged with United Airlines. It did make it through the Great Recession without going bankrupt, but it was a closely run thing. So Continental was what's called a legacy airline. It's got a high-cost structure with lots of debt, okay, and at this time, the bad economy was reducing its sales, and new low-cost competitors were eating into its market share, companies like Southwest and JetBlue. And at the same time, due to the Iraq War, the price of fuel was skyrocketing. So using our common size statements, we might want to ask, for example, how is Continental doing, if we go back in time to Q4 2008, based on its past 6 quarters of performance. And what I've got on the next page here are the going back in time from Q4 2008, the most recently filed 6 quarterly income statements. Okay, so each column is an income statement for one quarter, and the most recent quarter reported is on the right. The oldest quarter, the most distant in history, quarter reported is all the way to the left. And that's a convention we're going to use throughout this chapter and is very commonly used throughout all of finance. Um, so, one question with Continental is, should we compare our quarters sequentially or year over year? And what I mean by that specifically is, should we compare the quarter ending June 30, 2008 with the quarter ending March 31, 2008, the most recent quarter, or should we jump back a whole year and compare it to the quarter ending June 30, 2008 to the quarter ending June 30, 2007. So let's think about that a little bit, okay? If you look at the income statement revenues, you'll see that on a quarterly basis, the revenues are bouncing around a lot, and you can't see it here, but if we had more data, you'd be able to conclude that the overall year-on-year trend is up. To better help us answer this question about how we should compare the most recent quarter to something else, either the immediately prior quarter or the year ago quarter, that would be called a year-over-year comparison, we can look at Continental's most recent annual filing with the SEC, which is called a 10K filing. And in this filing, Continental and pretty much all companies have to state whether they are a seasonal company, where it's appropriate to analyze a lot of things for them year over year, or a non-seasonal company where it's appropriate to compare quarter to immediately prior quarter. So here's what Continental said in its 10K. Due to greater demand for air travel during the summer months, our revenue in the second and third quarters of the year is generally stronger than revenue in the first and fourth quarters of the year. Our results of operations generally reflect this seasonality, etc., etc. That implies that Continental is what we call a seasonal company, in which case we've really got to make comparisons on a year-on-year basis. And the reason for that is because if Continental typically has a strong quarter, if its strongest quarter is the third calendar quarter of the year, and typically the prior quarter ending June 30 is a weak quarter, there aren't as many people flying. It's just not fair to compare these two. So we'd want to jump back a whole year to the quarter ending September 30th, 2006 and compare that with 2007. So that's going to be true for any seasonal company. That's going to be true for companies like Mattel, that sells a gazillion Barbies around Christmas and Hanukkah time, and they don't sell many Barbies throughout the rest of the year. So their fourth quarter revenue is way much higher than their first, second, and third quarter revenue. And in the second quarter, they've got to typically borrow a lot of money so they can buy all the plastic to mold that plastic into the Barbies that they're making in the third quarter. So we'd want to compare second quarter to second quarter, and we'd want to compare fourth quarter to fourth quarter. etc. So Continental fits into that type of company, a seasonal company. Something like a commercial bank, for example, like Wells Fargo, would be a good example of a non-seasonal company. Typically, people's banking does not move up and down too much with seasons. Another example would be a company like Procter and Gamble that makes, for example, baby diapers, paper towels, laundry detergent, things like that. These are commodities that we all use throughout the year, irrespective of holiday season, school vacations, etc. Okay, so Continental, seasonal company. Typically, we're going to want to compare a lot of quarterly information year over year. And so now what we could do, I'm going to alert you, I'm going to jump around a little bit. If we wanted to use the common size income statement method for looking at Continental's results, what we'd like to do is morph this set of 6 income statements, one income statement per column. We'd like to morph that into, for each column, a set of percentages where every number in the column is going to represent a percent of the top number in the same column, which is the sales in the same quarter. And so I've gone ahead and done that for us here on page 11. And so what do we see? For each quarter, every number in that quarter, okay, not across quarters, but in that quarter, is divided by the company's revenue in that quarter. So we divide revenue by revenue, we get 1 or 100%. We divide cost of goods sold by revenue, and we get 81.6%. So how did we get this 81.6%? We got it by dividing here 2,593 by 3,197, and etc., etc. For every number in this column, we divided it by 3,179. Then we go and do the similar thing with this column and do the same thing for all the remaining columns. And we wind up with this. And this is really nice because it's helping us to understand now how, as a percent of sales over time, things might be changing, okay? And one thing you can see relatively quickly, we only have 6 quarters, so we can't compare too much, but if we compare June 30, 2008 with June 30, 2007, we see a 10% increase in cost of goods sold. That's a pretty whopping increase, okay? And if we look at March, quarter ending March 31, 2008, compared to the prior year's quarter, we have about a 4% increase in COGS, which is also pretty big. Okay, so we can see that Continental's costs are increasing on a year-over-year basis, and we can see that that trickles down to net income. We have negative net income in June 30, 2008, prior year quarter positive net income, negative net income in the quarter ending March 31, 2008, and we have positive net income in the prior year. So these common size statements are helpful for this type of analysis. And that's about all as far as I'm going to go with this. So I am not going to hold you responsible for the information about common size statements. I want you to be aware of them because you will see them throughout your careers in finance, and I want you to understand what they are. But honestly, I'm not going to test you on them. You can read more about common size statements in the text portion of your finance package, Intro to Business Finance package, and that will give you a lot of information on how common size statements are typically done with balance sheets. Okay, and again, I'm not going to get into that here. Okay. One reason I'm not going to get into that is that we can do so much better in financial statement analysis by doing what we call ratio analysis. With common size financial statements, clearly there's a lot of noise going on. Some ratios are going to be more useful than others. A lot of ratios are not going to be very helpful. And the common size statements are restrictive in that we can only compare an income statement number to an income statement number. And I'm here to tell you that neither the accounting nor the finance police are going to come in and arrest you if you make a ratio with, for example, an income statement number in the numerator and a balance sheet number in the denominator. That's something that clearly our common size statements don't allow. So what we want to do is improve on them by focusing on just the most useful ratios, however they need to be constructed. So we will be able to use ratios that draw on different financial statements. And then the other thing we're going to do is we're always going to compare an entity's ratios to its history and to a comparable or a set of comparables in its industry. So here's a quick example of what I'm talking about. One ratio we will talk more about in this chapter is called the asset efficiency ratio, and it's defined to be, this double equal sign means defined to be, sales in the period, this will be in the quarter for Continental, divided by the assets the company had at BOP. BOP stands for beginning of period. This is an extremely helpful ratio. Here's the intuition about this ratio. It answers the question, give it the assets that your firm had at the beginning of the period, how much sales were you able to squeeze out of that set of assets? That's an awesome question to ask, and knowing the answer to that question, I would say, being one of the nerdiest folks I know, is equally awesome. And then we're going to take this ratio and compare it to our entity's history to see if it's improving, if it's squeezing out more sales per dollar of assets over time. And we're going to compare it to the company's comparables to see if other competitors are squeezing out more sales per dollar of assets than, in our case, Continental, the primary company that we are looking at.